Welcome to this journey where we are going to answer an important question. What is a simple moving average? By the end, you will not only understand what a simple moving average is, but also why it is such a powerful tool for traders to identify trends and make better decisions. Get ready because we are going to make this interesting and easy to understand. Before we jump in, let me paint a picture for you. Imagine trying to navigate a winding road on a foggy day. You can barely see what is ahead, and every twist and turn feels unpredictable. The stock market can feel just like that, full of ups and downs with no clear direction in sight. Have you ever felt overwhelmed trying to understand whether a trend is happening or if the market is simply chaotic? This is where the simple moving average comes in. It acts like headlights that cut through the fog, helping you see the path clearly and understand what is really going on. A simple moving average takes the average price of an asset over a set period. For example, if we look at a 10-day simple moving average, we take the closing prices of the last 10 days, add them up, and then divide by 10. This means we get a fresh average each day that helps us see the bigger picture. Each day, the oldest price is dropped and the newest one added, which means it is always changing and updating itself. Now, let us dive deeper into some common chart patterns that are often used by traders to help understand the market more clearly. These patterns can be easier to spot when combined with the simple moving average. One key pattern is the double top. The double top is the opposite of the double bottom and often signals a reversal in an uptrend. Imagine the price climbs to a certain point, falls back a bit, and then rises again to about the same level before dropping significantly. This creates an M shape on the chart. When the price falls below the moving average after forming the second peak, it can signal that the asset is losing its strength and a downward trend may be about to start. Another important chart pattern is called the rising wedge. Imagine the price of an asset is climbing steadily, but each time it moves up, the increase is smaller, and each time it drops, the drop is smaller too. This creates a wedge shape that gets narrower as it rises. Think of it as the price trying to move up but running out of steam. It is like a car that keeps climbing a hill but is slowing down with each push, eventually struggling to keep going. This pattern often shows that the upward movement is losing its strength. If the price then drops below the simple moving average, it is a signal that the trend could be reversing and a downturn might be coming. Traders see this as a sign that it may be time to prepare for a drop or even consider selling if they expect the downward trend to continue. Conversely, we have the falling wedge pattern. The falling wedge is when the price makes lower lows and lower highs, but again, the distance between them gets smaller. It forms a narrowing wedge that points downwards. This pattern can indicate that the sellers are losing strength, and if the price breaks above the simple moving average, it could be the start of a new uptrend. Another pattern traders often use is called the cup and handle. Imagine the price forming a rounded bottom which looks like the shape of a cup, and then a smaller downward movement to the side which forms the handle. If the price moves above the moving average after forming the handle, it can be a strong signal that the price is ready to continue moving upward. This pattern is often used to identify potential buying opportunities after a period of consolidation. We also have the flag and pennant patterns. A flag forms when the price moves strongly up or down and then starts moving in a narrow range, forming a rectangular shape. This can look like a flag waving from a flagpole. If the price breaks out of the flag and moves above the moving average, It can signal that the trend will continue in the direction it was moving before the flag formed. A pennant is similar to a flag, but instead of a rectangular range, the price movement starts to converge, forming a small triangle. Pennants also often signal that the trend will continue once the price moves beyond the converging lines. By understanding these chart patterns, like double tops, wedges, cups and handles, and flags or pennants, you can combine them with a simple moving average to get a much more complete picture of what is happening in the market. These patterns are easier to understand with practice, and the simple moving average can help you confirm when the price is either gaining strength or losing momentum. This way, you can be better prepared to make informed trading decisions based on clear signals. And why do we call it simple? It is because every day in the period we are looking at gets the same importance. No single day is treated as more significant than the others. This makes it straightforward to understand and easy to use, which is why many traders prefer it. Unlike other indicators that use complex calculations, the simple moving average is exactly what the name suggests: simple and effective. By adding up the prices over a specific number of days and dividing by that number, you get a clear average that helps smooth out the ups and downs. It cuts through the noise, giving you a cleaner picture of what is happening overall. That is why so many people, from beginners to experienced traders, find it to be such a valuable tool. Now, you might be wondering, why should you even care about this simple moving average? The answer is that it can really help you with your trading decisions. It can help you identify trends so that instead of getting lost in the daily ups and downs, you can actually see whether things are going up, down, or just staying flat. Think of it as a way to see the forest through the trees. Another reason traders use the simple moving average is that it helps reduce the noise of the market. Prices move up and down all the time, often for small reasons, and sometimes for no reason at all. This movement can be confusing, but the simple moving average helps smooth things out. When you smooth out the prices, you can start to understand the real direction of things without getting distracted by every small move. It gives you a clearer view. And lastly, one of the most important reasons people use the simple moving average is that it is simple, just like the name says. It is easy to understand, easy to use, and it works well for people who are just getting started with trading. But it is not just for beginners. Many experienced traders also use the simple moving average because it is such a reliable way to see what is happening in the market. Let us talk a little about the different kinds of simple moving averages that people use. There are short-term, medium-term, and long-term moving averages, and each one works a little differently depending on your style of trading. The short-term moving average usually covers 10 to 20 days. It reacts very quickly to price changes, which is great if you want to catch short-term trends. If you are the kind of person who wants to jump in and out of the market quickly, this might be the right choice for you. Short-term moving averages move fast, just like short-term traders. There is also the medium-term moving average, such as the 50-day moving average. This kind of moving average is popular with people who like to take their time a little more. It is not quite as fast as the short-term one, but it is also not as slow as a long-term one. It sits in the middle, and it helps traders confirm whether a trend is still in place or if it might be changing. It gives you a clearer view of what is happening without reacting too much to every tiny move. And then there is the long-term moving average, like the 200-day moving average. This one is great if you want to see the really big picture. It is much slower to react, but that makes it more reliable for people who want to avoid the noise of the day-to-day market moves and instead focus on the longer trends. Investors who are thinking about holding onto things for months or even years tend to look at the long-term moving averages. They help show if an asset is generally going up or going down over time. When we look at charts, there are certain patterns that can help us make sense of the market, and using the simple moving average can highlight these patterns more clearly. For instance, one common chart pattern is the double bottom. Imagine the price drops to a certain point, then bounces back up, only to drop again to around the same level before rising once more. This creates a shape that looks like the letter W. When the price starts rising after the second dip and crosses above the moving average, it can signal that the asset is gaining strength and might continue to go up. This pattern shows that the price has tested a low level twice and has found enough support to move higher. Another well-known pattern is the head and shoulders. In this pattern, the price moves up to form a peak, which is like the left shoulder, then drops a bit before rising again to an even higher point, the head. After that, the price falls and rises once more to about the same level as the first peak, forming the right shoulder. If the price then falls below the moving average, it can be a sign that the asset is likely to keep moving down. This pattern shows a struggle in the market where the price cannot keep moving higher and eventually starts losing strength. We also have the triangle patterns, which are either ascending or descending. In an ascending triangle, the price moves up and down, but each time it drops, it does not fall as much as before, forming a flat top and a rising bottom. This shows that buyers are getting stronger, and if the price breaks above the moving average and continues higher, it might signal a strong upward move. A descending triangle, on the other hand, has a flat bottom and a descending top, which means sellers are in control. If the price falls below the moving average, it can be a sign of further decline. By understanding these chart patterns and combining them with the simple moving average, you can get a clearer picture of what might happen next. The simple moving average helps confirm these patterns and makes it easier to spot when the price is gaining strength or losing momentum. This makes it a powerful tool for traders who want to better understand market movements. Now that we know what the simple moving average is, let us talk about how you actually read it when you see it on a chart. This part is really important because once you can read it, you can use it to guide your decisions. When the price of an asset is above the simple moving average, it means that the asset is in an uptrend. This can be a signal that the market is moving in a positive direction. It could be a time to continue holding or even to buy. On the other hand, when the price is below the simple moving average, it is usually a sign that the market is trending down. Traders often take this as a cue to either sell or avoid buying at that time. One popular way to use the simple moving average is by looking for something called crossovers. A crossover happens when a short-term moving average crosses above a long-term moving average. When this happens, it often signals the start of an uptrend. Traders call this a golden cross. It is a good sign that things are moving upward. On the other hand, when a short-term moving average crosses below a long-term moving average, it is called a death cross, and it usually signals the start of a downtrend. Another way traders use the simple moving average is by treating it like a line of support or resistance. In an uptrend, the simple moving average can act like a support level. This means that even if the price drops, it might bounce off the moving average line and then continue higher. This can be a great time for traders to enter or re-enter a position, expecting that the trend will stay strong. In a downtrend, the simple moving average can act like resistance. The price will often try to move higher, but struggle to break above the moving average line. When it fails to break through, it is a sign that the market is still weak. Traders use this information to decide not to buy or even to sell. You can also combine the simple moving average with other indicators to make your analysis even stronger. One great example is using it with the relative strength index. The relative strength index helps show if an asset is overbought or oversold. For example, if the price crosses above the simple moving average while the relative strength index indicates that the asset is oversold, this could be a great opportunity to consider buying, as it suggests the price may be ready to rise. This combination helps to confirm the strength of the trend and gives more confidence in making decisions. Another chart pattern that works well with the simple moving average is the double bottom. Imagine the price drops to a certain level, then bounces back up, only to drop again to around the same point before rising again. This forms a W shape. When the price moves above the simple moving average after the second bounce, it can indicate that buyers are coming back in, and the asset could continue to move upwards. The moving average helps confirm that the trend is gaining strength. Similarly, the head and shoulders pattern can also be combined with the simple moving average. The price forms three peaks, with the middle peak being the highest, which looks like a head and two shoulders. If the price falls below the moving average after forming the right shoulder, it can indicate that the market is losing strength, and it may be a signal that the price could drop further. Using the moving average in this way helps you confirm when a trend is ending and when it may be time to take action. These examples show that by combining chart patterns with the simple moving average, you can better understand market signals and make more informed decisions. It helps to smooth out price movements and confirm when a trend is likely to continue or reverse. Another helpful indicator to use with the simple moving average is Bollinger Bands. Bollinger Bands show how much the market is moving up and down. If the price breaks out of one of the Bollinger Bands and you also see a simple moving average crossover, this can be a very strong signal that a big move is coming. One more thing to consider is the volume of trading. Volume is how much of an asset is being traded. If the price crosses above the simple moving average with a lot of volume, that is a much stronger signal than if the volume is low. So always check the volume to make sure the move is real and strong. Now let us talk about some common mistakes that people make when using the simple moving average so you can avoid them. One mistake is ignoring the time frame. If you are trading in the short term, using a long-term simple moving average might be too slow to be useful. On the other hand, if you are an investor looking at the big picture, a short-term moving average might be too noisy and distracting. Another mistake is relying only on the simple moving average. Remember that it is a lagging indicator. This means it follows the price rather than predicting it. You should always combine the simple moving average with other indicators, like the relative strength index or Bollinger Bands, to make sure you have a complete picture. One final mistake is overreacting to small crossovers. Not every crossover is a sign of a big move, and sometimes the price might just be making a small adjustment before continuing on its previous path. It is important to look at other factors, like the volume of trades and the overall market conditions, before deciding to make a trade. For example, if a crossover happens but there is very little trading volume, it might mean that the signal is weak and not enough people are supporting the move. Also, consider the broader market context. If the market is reacting to a major event, crossovers could be misleading because the movement might just be a temporary reaction. This is why crossovers should not be used alone, but rather as part of a larger strategy, combined with other indicators to confirm the move. So, how do you get started with the simple moving average? First, decide on your time frame. Are you interested in short-term, medium-term, or long-term trends? If you are trading actively, a 20-day moving average might be best. This kind of moving average is helpful if you want to make quick decisions based on the recent price trends. It reacts quickly to changes, making it a good choice if you are focusing on short-term price movements. For those interested in medium-term trends, the 50-day moving average can be very useful. It offers a balanced view, allowing you to filter out some of the daily noise while still reacting relatively quickly to changes in the market. Medium-term moving averages can help confirm trends and ensure that you are not jumping in too early or waiting too long to act. If you are investing for the long term, you might want to look at a 200-day moving average. The 200-day moving average is slower to react, but is great for seeing the bigger picture. This kind of average is often used by long-term investors who want to focus on major trends without being affected by short-term price swings. It gives you a sense of whether an asset is in an overall upward or downward trend, which can help you decide whether to hold onto your investment or make changes. By understanding these different time frames, you can choose the moving average that best suits your trading or investing style. The key is to match the moving average with your goals, whether you are looking to make quick decisions or are in it for the long haul. Next, apply the simple moving average to your chart. Most charting platforms make this easy. Just select the indicator, choose the number of days, and watch as the line appears on your chart. Now you can start looking for trends and crossovers. Is the price above or below the moving average? Are there any crossovers happening that could indicate a change in trend? Use these signals to guide your decisions. Let us wrap up everything we have talked about. The simple moving average is a tool that smooths out price data and helps you identify trends. It can be used for short-term, medium-term, or long-term analysis, depending on what you need. Whether you are looking at a 10-day average or a 200-day average, the simple moving average can help you make better trading decisions. Remember to experiment with different timeframes and combine the simple moving average with other indicators like the relative strength index or Bollinger Bands. And always keep an eye on the volume to make sure your signals are strong. With practice, the simple moving average can become a powerful part of your trading toolkit. Keep practicing and do not be afraid to ask questions or share your thoughts as you learn. It is all about building confidence and getting comfortable with the tools that can help you trade more successfully. Thanks for joining and good luck as you continue your trading journey.